My name is Jake. Welcome to the channel. Welcome to the new year, everybody. Happy New Year. In today's video, I want to take a look at the market prediction, the forecast for 2023 from Vanguard. I generally don't listen to all the noise out there, all the clickbait videos that you see on CNBC or here on YouTube, or, different articles on, a recession is looming, all of this, you're going to lose all your, I generally just kind of avoid those kind of videos and blogs. This video, I just really want to take an objective view on and listen and see what Vanguard is saying when it comes to 2023. I made a similar video last year in January around cash flow is king. Now, this video was inspired a lot of the research that I was reading from Vanguard last year, and I thought it was pretty interesting. And a lot of the stuff, spoiler if you haven't seen this video, that I made last year, a lot of it actually came true, what Vanguard was saying and what other, what they were saying about what was going to happen here with growth versus value in 2022. So I thought it'd be pretty interesting. I want to do a similar video here in January, looking at, what is Vanguard saying when it comes to the economic and market outlook for 2023. But one of the cool things about what they're doing here is they're not just looking at 2023, but also projected over the next 10 years. So whether you have a 1-year time horizon or a 10-year time horizon, you'll get something out of this video. So right off the bat, I'm talking about future outcomes that have not yet taken place. I'm not a wizard, Harry. I'm not a genius. I'm never the smartest person in the room. I think that I can do research pretty well. I've spent hours on hours preparing for this video. I wanted to make sure that if I'm sharing something here on YouTube, that I want to make it valuable to all of you and make sure that the time that you're spending watching this video, that you're actually getting something out of it. But what is kind of cool is in 2022, growth was definitely suppressed, value shined. And, when looking at the total returns of my portfolio was down like almost everybody else. I don't invest in energy stocks directly, but my portfolio was down. The total return was down 4%. So 4%, not so shabby when comparing it to, for example, the S&P 500. The S&P 500 was down, this is almost poetic, like 20%, 20.01% is the, if you were to go to Google or Yahoo Finance, this is what you would see. But if you factor in the dividends reinvested and you go over here to percentages, you can see that, the total return for the S&P 500 was just under 19%. And it felt pretty dang good to be a dividend investor in 2022. So shout out to all of my dividend friends and dividend nerds out there. We shined, right? 2020, 2021, I felt like such an idiot. I was like, why am I investing into growth? Why am I not investing into growth? Like, what is wrong with me? And now it's like, yeah, how the turntables. But here really quick, I know a lot of you like Seeking Alpha like I do. They're having a flash sale until, I believe, January 3rd. It doesn't say anywhere January 3rd on their website, but I kind of have, insider with them. They're saying or indicating that this sale is going to be over January 3rd. It normally costs $239 for a year of premium. If you want to sign up using my link, you'll support the channel and you'll get Seeking Alpha Premium for $39. So once again, I believe, wink, wink, this will be over on January 3rd. But I want to make a really quick point that it is near impossible to reliably year over year predict the future when it comes to which sectors in the market are going to shine and which ones are not. When looking at the S&P 500 sector performance over the last decade plus, you can see that energy here in 2022 was the winner, right? Energy outshined all other industries or sectors. Utilities came in second place, just under for the year. Consumer staples did very, decent, right? Compared to the S&P 500 right here when looking at that. But when I look at this, I see that, no one can predict the future. No one knows if tech is going to outperform 1 year, if energy is going to outperform 1 year, or if real estate is going to do well. It's kind of that boom or bust kind of thing with some of these sectors. The S&P 500, you're just kind of getting the middle, the average, right? And that's why I love investing into, ETFs, because you don't have to pick the winners. And That's why I love broad-based, ETFs like SCHD or VYM or DGRO, because you don't have to pick the winners. All you have to do is dollar cost average into your portfolio, and over the long term, your average person is going to do okay. Because if you do try to time the market and you try to really go big into one stock, imagine you had a portfolio just of Microsoft, Apple, and Nvidia, your portfolio is going to be down. Some years it's going to be doing very well. Some years it's going to be doing very poorly. And you never know what your portfolio is going to do year over year. Going into 2022, things were looking pretty good. And it kind of looked a little like this.
Mr. Speaker, I am a fighter and not a quitter.
Hello, Mr. George. How much you pay for the new guy? $20? No, too much money.
I am resigning.
Oh my gosh. Oh, it's a masterpiece. Oh, we're starting the year off with a bang. I love it. I love it. All right, cool. So let's take a look at this. So I want to walk through this document here. There's about 60 plus pages, and I've highlighted the areas that I think are, for me personally, just really interesting. This document or their forecast, they talk about it globally. I'm going to focus primarily on the US. They go into, talking about the UK, EMEA, emerging markets. I will leave a link to this PDF here in the description below. If you want to check it out and follow along, you can get the link in the description below. So first off, with their economic outlook, they're really highlighting that inflation was the boogeyman here in 2022, and it will continue to be the boogeyman going forward into 2023. And it's ultimately, in most cases, going to cause a global recession in 2023. So this really caught my eye, that they're starting out saying there will be a recession, a global recession in 2023. And they go on to say here that, given the financial conditions that we're in, with the increased policy rates from the Fed, energy concerns, declining trade volumes, whether it be with China or other pockets of the global, economy, that is indicating that the global economy will likely enter into a recession in the coming year. And this is really going to spark continued job losses in technology and real estate sectors. So if you work, it's kind of that blue collar, white collar dilemma. These last 10 years, white collar jobs have been prosperous and really been up and to the right, where blue collar jobs, think about somebody in Michigan, right, working in a factory, or somebody that's working with their hands, not necessarily a knowledge worker. Their time to shine is now. Right? Whereas technology workers or knowledge workers, they're scrambling. And I know this because I laugh, but I'm kind of like cringing underneath. It's like, I work in software sales. I see every single day people that I know getting laid off. It's a reality. And for some people out there, that's not really a concern because they don't work in the tech sector or in the real estate sector. Things are just booming. So this recession is going to impact different areas of the economy. If you're a blue collar worker out in Alabama, things are good. Times are, you're booming, right? But if you're in Silicon Valley and you have a lot of debt and you get laid off, it's not a recession, it's a borderline depression. Okay? That's how it was similarly in the 08 and 09 financial crisis. When your neighbor loses their job, it's a recession. When you lose your job, it's a depression. And I believe that as we go into this next year, as more layoffs come, and we'll talk about that here in a second, you're going to see more and more of that. So they go on to say here that inflation has already peaked, or likely already peaked, and such that central banks may reasonably achieve their 2% inflation targets, but only in 2024 or 2025. That means in 2023, there's more pain to come for the market. But once again, white collar versus blue collar, it depends on who you are. So it's not going to impact everyone equally at least when it comes to their active income from their day job. So equity markets have yet to drop materially below their fair value range, which they have historically done during recessions. Now, what this is talking about here is the price to earnings ratio. And we'll touch on that here in a second. PE ratios historically for, economic recessions, standards were still pretty overvalued. And that's what they're saying here in this forecast, that we actually have a ways to go on to the downside when it comes to reverting back to historical means. And so look out for that. But here's something that's maybe a little bit optimistic, that they're saying that Vanguard is actually projecting over the next 10 years, annualized, over the next 10 years, that the different markets are going to be impacted differently. So non-US developed markets, think of like Japan, think of the Europe, stuff like that, countries like that, maybe Canada, that they're going to see higher returns of 7.2 to 9.2% annualized returns. That's pretty good. And then emerging markets, think maybe Brazil, other emerging markets, maybe China. I don't know. There's a ton of them out there. Think between 7 and 9%. And US markets are going to see depressed returns of 4.7 to 6.7 returns. Okay. Now that's still beating inflation, assuming that that we get inflation down to that target of 2 to 3%, give or take. So you're still going to have real returns, but nowhere near what they were the last 10 years. All right, so when looking at their economic forecast, let's take a look at a couple different categories here. We're looking at GDP growth, unemployment, headline inflation, and monetary policy. Okay, now I want to focus here on the US. If you're in different areas of the globe, in the world, you can see kind of where that aligns. But here in the US, they're forecasting or projecting economic growth, or GDP growth of around 0.25%. But here's the interesting thing here is the unemployment rate. Unemployment rate, what they're forecasting is that it's going to jump to 5%. Okay, so what does that mean? Right now we're sitting at 3.7% unemployment, and they're projecting over the next year that we're going to jump up to 5%. So 5% is going to bring us back to about, August of last year. So things in August of last year were not so bad. I mean, I think things were still going pretty well, I guess. But what does that mean in terms of individuals that are going to potentially lose their job? Here, let's see. Right now we're sitting at 6 million. If we go back to August of last year, we're going to see about 8.3 million people. That means 2.3 million people from now until the end of the year, they're forecasting are going to lose their jobs. 2.3 million people. What did I say earlier? If your neighbor loses their job, it's a recession. If you lose your job, it's a depression. For 2.3 more million people, they're going to be entering a depression going into next year. All right, moving on here to monetary policy. So we know that the Feds, raised interest rates to 4.25%. They've indicated that they're going to get to, I think, 5.1%. Vanguard is projecting that they're going to land at the end of next year at 5%. So still a decent leg up from where we're at today. So the really big takeaway for me is if we really get to a 5% unemployment rate, that means that we're going to see a 40% increase from where we are today. And that's pretty scary. So coming back here briefly to the monetary tightening, each country is going to tighten or is projected to tighten at a different pace. And here in the United States, like I mentioned, they're projected to increase to 5% in 2023. When you compare that to where we've been, we haven't seen those rates since the since the financial crisis of 08 and 09. So pre-financial crisis. So you boil it all down, what does that mean? Here's the headliner for you. Vanguard is projecting a 90% chance that we have a recession by the end of 2023. And they're citing that the main drivers for this is going to be the Federal Reserve continuing to tighten, and that inflation is going to continue to erode consumer purchasing power. Okay, so a 90% chance that we're going into a recession. Yikes. Okay, so what is this going to be driven by, or what are they looking at when factoring in what is a recession? Because that was kind of a fun topic this year. We're kind of reinventing what a recession is and what it isn't. Two consecutive quarters of GDP declines, or what is it? So the global recession indicators for them, for Vanguard, what they're looking at are these things right here: the global unemployment, the real per capita GDP, the industrial production, the foreign direct investment, the trade, and the global energy demand. And so based on a combination of all of these, you can see that we're back at, we're approaching where we've been in the past, where we've seen recessions, right? Whether it be during the dot-com bust, financial crisis, or even all the way back into the 70s and the 80s. Okay, so once you get past this point where we're where we're actually at, there's a 50% probability of a recession. But the thing is we're not going to stop here. Likely is what they're saying. We're going to continue going up. Indication that we're going to be entering a recession. And I thought this was really interesting. So when they're comparing, global recessions versus now, how do we compare? We can't predict the future. We can only look at, what's happened in the past. And I love that saying, the past doesn't repeat, but it rhymes. The past has a story to tell. But when you look at those indicators, we're already past, when you look at when a typical recession occurs, that is this dark gray dot. When you look at the light dot, this is the year before a global recession. And the green dot is where we were at in 2022. So when the green dot is further to the left than the gray dot, that's bad. That means we're likely going to see, it's indicating that we're going to see a recession. So for global unemployment, we're doing worse there. For gross domestic savings, we're worse there. For trade, we're worse there. And then with these other three here, with industrial activity, global energy consumption, and real per capita GDP growth. So the indicators here are really screaming recession. So the real issue of why we're here where we're at is because of inflation, and because the Fed has no choice but to respond to this and to tame inflation. And what Vanguard is saying here is that as we step into 2023, early signs of recovery in goods supply and a softening demand could help balance supply and demand for consumption and bring prices lower. But the expectations of a stronger pickup in services, especially in the stickier component of shelter inflation, this is your rents in most cases here, will keep inflation from falling back quickly. We see inflation by the end of 2023 settling at 3%, which is still higher than the Federal Reserve's inflation target of 2%. In other words, we do not see inflation returning to target next year, meaning that the Fed is in a sticky situation here. What do? Are they going to pivot? And this whole notion of, the Fed's going to pivot or not, they're not going to likely be able to pivot. And if they do, we're going to see a repeat of the 70s. And we don't want that. So this next piece that I want to go over, I think was really interesting, because Vanguard, they do these market predictions or forecasts on a regular basis, I believe annually. And 10 years ago, they did an outlook of what the market would look like. And that's what we're seeing here on our screen now. And they did it for the US and for international equities. So this is just equities, not bonds or anything like that. But what the figure below is showing is that the global sell-off is bringing US returns closer to their Vanguard's forecast from 10 years ago, but the international equities have continued to underperform their expectations. So if you can see here, what they projected or forecasted back 10 years ago, that annual returns would continue to grow, between, around 6 or 7% here annually, and that we're well above their projections going forward here in the US. But when looking internationally here on the right, that we're well below their projections of what they expected global markets or international equities to do over that time period. And it just kind of shows how the US is now currently overvalued, and that international equities are undervalued. And a lot of that has to do with what I was mentioning earlier, at the very beginning of this with the projected returns, how now going forward, the projected returns of international equities is higher given the where we're at today versus US equities. The expected returns are lower because we're still overvalued. And when talking about valuation, this is really factored or considered based off of the price to earnings ratio. And when you look at this, you look at US equity valuations over the last couple of decades, we're still overvalued, but we're much more, it's a much fairer valuation today than we were a year ago. So what does that mean? If you're a new investor and you're just starting to invest, every dollar that you invest today, you're getting more bang for your buck than you would have had you started last year. Or if you've been investing in dollar cost averaging over these last couple of years, you were paying a higher valuation or you were getting less bang for your buck last year. And now this year, you're getting more bang for your buck. So right now, this is going to be the key topic going into 2023. So I mentioned earlier that 2022, I was talking about cash flow is king. 2023 is all going to be all about margins, right? Our company's going to be able to sustain their margins, and margins are going to be stressed because inflation is going to come down. The price of goods and services are going to come down, and that is going to hurt margins on companies. So what does that mean? It means that the margins here in the US, companies here in the US, that they're going to come down. But what Vanguard is saying is they're projecting that margins are not only going to come down, but they're going to come down below their historical average, down to 5% from, instead of the historical average of 6.4%. So margins are really, really going to be hit here in 2023. To summarize, what Vanguard is saying is that a balanced portfolio is still going to offer the best chance of success. Now, I like what they say here about chance of success because they don't even know what's going to happen, right? And in this forecast, they model out different scenarios, right? And they're not just looking at equities here in the US or international, they're also looking at fixed income, they're looking at bonds. And what they're saying is, for the normal investor, your best chance of success here, not only in 2023, but actually over the next 10-year time period, when looking at annual returns, your best chance of success is the 60-40 portfolio. The 60-40 portfolio has been kind of that gold standard for portfolio allocation over the last couple of decades. Now, last year, I saw a lot of headline articles where people would say the 60 portfolio is dead. That was back when there was, low inflation, zero interest rates, but now we're in entirely different economic conditions. The 60-40, what Vanguard is saying, you're going to have the highest chances of success with a 60-40 portfolio allocation. But here really quick, before I move on to, sharing my thoughts on this and how I'm looking at investing going into the next couple of years, I want to preface here that the 60-40 portfolio, I'm not saying that everyone out there watching this video should go and invest into the 60-40 portfolio. I'm not saying any of that. I'm not advocating for anything like that. What I would encourage you to do is, if you don't understand what the 60-40 portfolio is, or you don't know what portfolio allocation modeling is, that's a good incentive to go and start researching and learning more about it. Okay. Bonds are great for the right individual with the right time horizon. If you have a long-term time horizon, the 60-40 portfolio, I don't know, it may not necessarily be the best thing for you if you have a long-term time horizon. Okay. And if you don't know what that means, I would encourage you to go on my channel and watch some videos that I've made on how to invest based off of your time horizon. Now I want to share a few thoughts on my opinion on how to invest into 2023 and potentially, 2024 and 2025, because that's what it sounds like, that we're not going to be out of the woods here for the next couple of years. So buckle up, buckaroo. We might be here for a while. When I say here, I mean kind of in the woodshed when it comes to Jerome Powell's The Fed's woodshed. we're in there. So a couple of thoughts from my end. All right. So first off, I think that we're going to see a lot more of the same in 2023 that we did in 2022. There's going to be a lot of noise. There's going to be a lot of headline noise. If you watch CNBC or Yahoo Finance or whatever, you're going to see a lot of noise. So just make sure that you understand that. I think that value is going to continue to outpace and beat growth. We saw here that real estate and technology is probably going to be hit the hardest. So if you work in those sectors, make sure that you have a really healthy emergency fund, okay? Really, really important. I think that bond yields are going to remain high. I think that interest rates are going to remain high. It's going to be very difficult to buy a home if you're an average person. You're going to, things are going to be pretty tight. Okay. And I believe that we're going to see more of the same with inflation. Yes, it's likely peaked. Yes, it's probably coming down, but I think inflation is still going to be the boogeyman and the biggest topic in how the Fed responds to inflation here in the entirety of 2023. I think 2023 is going to be value over growth. It's going to be layoffs in the tech and in the real estate sector and potentially trickle into other areas of the market, right? It's going to be inflation and it's going to be interest rates in the Fed. More of the same. And then all of those other, enter your wild card for whatever happens in, other areas of the market with China and, all that other stuff. The second thing here is I think that, the stock market usually tends to bottom, meaning the S&P 500 usually bottoms 3 to 6 months before we see the worst economic data be publicly available. So the market generally tends to sniff out when the market is gonna, bottom before it actually bottoms. So when you're seeing the stock market do what it does, and when you're watching CNBC, you're gonna see a disconnect. They're not gonna be the same. And you're gonna be scratching your head, what the heck is going on? It's because the market generally bottoms before you actually get the worst economic data, okay? We've seen that in almost every single recession. It's just one of those things that just happens, okay? So just bear in mind that the market may already be going up when the worst is still, still happening, in terms of the headline news. The last thing here that I would say, my takeaway, in my opinion, going into 2023 is know your time horizon, right? If you understand that you have a 10 or a 20-year time horizon, you should not be listening to the short-term headline news. You should be not panicking and selling all of your stocks. This is the best thing that could have ever happened to you. The very best thing. If you have a short-term time horizon, you probably want to, position your portfolio and invest the way that's going to shield you and protect you from short-term volatility and kind of unpredictability in the market. But if you have a long-term time horizon, honestly, this is the best thing that could have ever happened to you. And I know it's a little bit weird. You're going to have to do a little bit of brain gymnastics to make sure that you convince yourself of that. But just understand, if you have a long-term time horizon, you can't pick the bottom, dollar cost average into your portfolio and chill. Right? That's what I'm telling myself. I hope that this helps everybody. There's a lot of noise. There's a lot of fear and FUD out in the market. Take care of yourself. Understand what situation you're in. We talked a lot about how these market conditions are going to impact people differently. If you're sitting in Silicon Valley versus maybe in Iowa, you have different things to worry about. But regardless of that, everybody should have, hopefully, a healthy emergency fund of 3 to 6 months that cover all of your expenses, regardless of what happens, because Vanguard is saying 2.3 million people are likely going to lose their jobs here in 2023. So be safe, everybody. Take care of yourself. Be smart. And I'll see y'all in next week's video.
Please subscribe. Please subscribe.
Subscribe.
Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along. partner.